The main difference between traditional futures and perpetual futures, or Perps, is simply regular futures expire, perpetual futures don't. Traditional futures have a fixed contract date. For example, you might trade a September oil futures contract, and as that date gets closer, the contract eventually expires. At expiration, the contract settles. Depending on the contract, that can mean cash settlement or it can mean physical delivery. But for most retail traders who don't want to close the position, and they probably definitely don't want to take delivery of barrels of oil to their front doorstep, in order to keep a traditional futures position open past expiration, they usually have to roll their position. Now, rolling is basically closing the expiring contract and immediately opening a later dated contract. That's just normal in traditional futures. But it does add friction. You have to understand the contract calendar, you have to understand expiration, you have to understand rolling, and you have to remember to do it. For a beginner, that's just a lot. Perpetual futures, or Perps, remove that part. They are designed to keep trading without an expiration date. So instead of having a contract that expires every month or every quarter, the Perp just keeps going. That's why it's called perpetual. It just keeps going. Now the obvious question is, if Perps never expire, how do they actually stay tied to the real asset's price? The answer is funding rates. A funding rate is a periodic payment between long traders and short traders in a perpetual futures market. Traditional futures use expiration to force the contract back towards reality. Perps use funding rates to keep the contract tied to reality. Basically, if an NVIDIA perp is trading above the spot share price of NVIDIA, longs might pay shorts. That makes it more expensive to stay long and more attractive to go short. That pressure helps pull perp price back toward the spot price. Now, if the perp is trading below spot, shorts might pay longs. That makes it more expensive to stay short and more attractive to go long. So funding rates are the mechanism that keeps perp price in line with the underlying market.